How governments are responding to cryptocurrency. Cryptocurrency has taken the world by storm. From Bitcoin's humble beginnings to the rise of thousands of altcoins, digital currencies have become a major player in global finance. But with this surge in popularity comes a question that every government must answer. How do we regulate cryptocurrency? In this video, we'll explore how governments around the world are responding to the growing influence of digital currencies. Let's break it down. Number 1. The early days, hands-off approach. When Bitcoin first emerged in 2009, most governments didn't know what to make of it. Digital currency, decentralized, no central bank. For many, it was seen as a fringe experiment that didn't require much attention. In those early years, governments around the world largely took a hands-off approach. They observed, they learned, but they didn't interfere. Some countries like the United States allowed Bitcoin and other cryptocurrencies to operate freely without any formal regulatory framework. It was a time of experimentation. Enthusiasts and early adopters were figuring out how these new forms of currency could be used, while governments stood on the sidelines. But as cryptocurrency began to gain traction, governments started to take notice, especially when major companies began accepting Bitcoin, and large amounts of money started flowing into crypto markets. This prompted a shift in the way governments thought about digital currencies. Number 2. Taxation and regulation, the turning point. By the mid-2010s, cryptocurrency was no longer a niche interest, it was mainstream. And with that, governments began to realize that they couldn't ignore it any longer. One of the first areas where governments took action was taxation. After all, if people were making money from cryptocurrency, governments wanted their share. In 2014, the U.S. Internal Revenue Service, or IRS, was one of the first government agencies to issue clear guidance on how to tax cryptocurrencies. They declared that digital currencies like Bitcoin should be treated as property, not currency, for tax purposes. This meant that every time you bought or sold cryptocurrency, it was a taxable event. Whether you gained or lost money, it had to be reported. Other countries soon followed suit. In the UK, the tax authority issued similar guidelines, treating crypto as property. Japan went further by legalizing Bitcoin as a form of payment in 2017, while also implementing strict rules around taxation and exchange operations. Taxation was just the beginning. Governments quickly realized that to regulate crypto, they needed to understand the technology behind it, and they had to create frameworks that ensured digital currencies didn't become tools for illegal activities like money laundering or tax evasion. Number 3. Anti-money laundering and know your customer (KYC) laws. As the popularity of cryptocurrency grew, so did concerns about its use in criminal activities. Because cryptocurrency transactions are often anonymous and difficult to trace, governments feared that criminals could exploit digital currencies to launder money or fund illegal activities. In response, many governments began implementing strict anti-money laundering, or AML, and know your customer (KYC) regulations. These laws require cryptocurrency exchanges to verify the identities of their users, just like traditional banks do. This ensures that transactions are transparent and traceable if needed. The European Union led the charge with its 5th Anti-Money Laundering Directive, which came into force in 2020. This regulation required crypto exchanges and wallet providers to adhere to AML and KYC rules, helping to bring more transparency to the market. In the US, regulators like the Financial Crimes Enforcement Network, or FinCEN, have enforced similar rules, requiring exchanges to report suspicious activity and keep track of large transactions. These measures are meant to reduce the risk of illicit activities, but they also bring cryptocurrencies closer to the traditional financial system making them more accountable. Number 4. Different approaches. Banning versus embracing. While some governments have embraced cryptocurrency with open arms, others have taken a different route. In several countries, rather than regulate crypto, governments have opted to outright ban it. China is the most notable example. In 2021, the Chinese government imposed a sweeping ban on cryptocurrency transactions and mining. It wasn't the first time China had cracked down on crypto. In fact, the country had been gradually tightening its regulations for years. But the 2021 ban was the final nail in the coffin for crypto activities within China's borders. The government cited concerns about financial stability, energy consumption from crypto mining, and the potential for illegal activities. Other countries like India have also considered bans, but with less certainty. India's government has proposed a ban on private cryptocurrencies several times, citing risks to financial stability. However, the country hasn't fully enacted the ban yet, and the debate continues. On the other side of the spectrum, some governments have fully embraced cryptocurrency. El Salvador made headlines in 2021 by becoming the first country in the world to adopt Bitcoin as legal tender. The country's president, Nayib Bukele, believes that Bitcoin can help El Salvador's economy by providing financial services to people without access to traditional banking. Number 5. Central bank digital currencies, CBDCs, the future of digital money. Perhaps the most significant response to cryptocurrency from governments has been the development of central bank digital currencies, or CBDCs. Unlike decentralized cryptocurrencies like Bitcoin, CBDCs are digital versions of national currencies issued and controlled by central banks. Several countries are already exploring or testing their own CBDCs. China's digital yuan is one of the most advanced projects, with the country conducting large-scale trials. The European Central Bank and the Federal Reserve in the US are also exploring the possibility of launching digital versions of the euro and the dollar. CBDCs aim to combine the convenience of digital payments with the security and trust of government-backed currency. They could offer some of the benefits of cryptocurrency like fast, borderless transactions while avoiding the risks of volatility and lack of regulation. As cryptocurrency continues to grow, governments are adapting, each in their own way. From strict regulations to outright bans to creating their own digital currencies, the world is watching closely. The future of cryptocurrency will depend on how these responses evolve. Will governments embrace the technology, or will they fight to control it? Only time will tell. And that's a wrap on today's journey into the world of cryptocurrency and government regulation. The future of money is changing fast, and we're just scratching the surface. Whether you're a crypto enthusiast or just curious about what's next, one thing is certain: the world of finance will never be the same. Thanks for watching. If you enjoyed this deep dive into how governments are responding to cryptocurrency, don't forget to like, subscribe, and hit the notification bell for more insights into the future of money. We've got plenty more exciting topics lined up to keep you ahead in the fast-evolving world of tech, money, and innovation. Thanks for watching, and we'll see you in the next one.